Hi, I'm Scott from Solace Financial, and this is a video market date for my clients, friends, and family. Well, firstly, I apologise that it has taken me so long to do another video. My excuses are the following. James, my eldest, he had some health issues and we were in hospital. He had brain surgery. He's all fine now, but really kind of everything goes out the window when you have a sick kid. So that was the whole focus. Then we came up to 30th of June. We prioritised clients' 30 June work then. And also another excuse is the budget, just getting our head around the budget, trying to work out what those rules are, how we can help clients and what we need to do regarding it. The ASX has been really choppy this year. Currently, the market for the 1 year is up 4%. But if I had have done this video 2 weeks ago, I would have told you it was minus 1%. So really is quite flat for the 1 year, but very choppy. The last 2 years look good. We've had a higher allocation than normal to international shares, specifically emerging markets, which are currently up about 20%. But again, if I had have done this video in July, that emerging markets return was actually 45%. So looking at those emerging market performance from July to now, it looks bad, but still up 20%. Anyway, all of that said and done, most clients' balanced portfolios are up about 8% for the financial year, which is a really, I feel is a good return for a pretty difficult year. Budget changes, war in Iraq, inflation levels, interest rates increasing. There's just been a lot of headwinds this year. Reporting season is amongst us at the moment, so we are spending a fair bit of time looking at the different profitability of companies. They're all starting to come out now. Our market is kind of expecting the worst, so we're hoping for some hidden good news in there, which could see a little bit of a rally in our market. We're hoping for that. For example, Rio Tinto came out and their earnings per share was up 42% for the year. So a really good return for Rio. We're hoping for some other gems in there. I want to quickly talk about the budget changes. It has been a little while since they first come out, but the dust really hasn't settled yet. There is still implementing alterations and changes to it. There are 3 key budget changes that affect our clients. First is the capital gains tax rules. Really, it doesn't affect previous capital gains. So everything before budget night, it's the same rules as it was. It's only the gains that are after that. And it is going to make it more complicated in the future working out capital gains for clients. And that's both from your accountant and us, because we need to kind of prorata it between the 2 different sets of rules and the cutoff period. It is probably going to be important to get valuations on things like investment properties sometime later this year, so we can have a clear line in the sand. This is how much your capital gain was before the rule change and then after going forward. The next one that they changed was negative gearing. This affects clients that are borrowing money to invest, and that could be borrowing money to buy an investment property or into shares or investment portfolio. Most of the clients that I see don't have negative gearing, they have positive gearing, which just means that the interest or the return on their investment is higher than the cost of it. So the interest that they earn from the investments is higher than the interest that they pay for borrowing to buy it, if that makes sense. That's the majority. So the majority of it doesn't affect that. The ones that it does, what they're saying is that we can use that negative gearing to offset future capital gains. So we can add it to the cost base. So really, you don't pay as much capital gains tax in the future. So you don't get the benefit now, but you do get it in the future. So I'm not really sure how this is going to help increase revenue for taxes. It is making it more complicated though. And the third one is trusts. This is probably a fairly big change. discretionary trusts are going to be taxed at a minimum rate of 30%. And we have the opportunity for the next couple of years to restructure clients that have discretionary trusts. I think it's going to be a case-by-case basis on how to best do that, whether we make it a fixed trust or whether we turn it into a company structure or whether we just keep it as a discretionary trust because the beneficiaries are all on the 30% tax rate anyway. So that one, there is a fair bit of work in it for us. My thoughts on the budget changes are the only people that really win out of these budget changes, in my opinion, is accountants and financial advisors. It is going to keep us busy. There is a lot more admin, there is a lot more paperwork, there is a lot more structure change, and I just can't see how it's significantly going to raise taxes for the government, raise revenue, and I cannot see how it's going to be better for clients. That's my pessimistic view on it. It's work that we don't particularly want to do because there's not value adding to you guys, to our clients. But I think it's going to keep us busy for the next couple of years, unfortunately. The other thing that's changed is there have been some superannuation limits that have changed. If it affects you, we'll talk to you about it individually, but quite simply, they've just indexed some of the contribution caps, the non-concessional contribution cap and also the concessional contribution cap, as well as the total super balance limit and also the transfer balance limit. That may not mean a lot to you, but if it does affect you, I'll talk to you about it individually. That's it for this month. Hopefully I don't have any excuses for not doing a video next month. Thank you very much for your time.